All right, today we're diving deep into the world of finance to crack the code on a product that sounds, well, incredibly complicated. But stick with me because once you get it, it's actually pretty fascinating. You know that feeling, right? Maybe you're at a coffee shop and you overhear the table next to you throwing around terms like knock-in barriers or structured products, and you just think, what are they even talking about? It can definitely feel like you're on the outside looking in. Well, today we're going to pull back the curtain on one of those very terms. By the time we're done here, you're going to know exactly what an autocallable is, how it works, and most importantly, if it's something you should even be thinking about. Okay, so to really get this, let's just forget all the intimidating Wall Street jargon for a minute. The best way to think about this is to frame it as a simple game. Seriously, this makes understanding how it all works so much easier. So what is this thing, technically? Well, it's a hybrid, kind of like a financial cocktail. You take the relative safety of a bond and you mix in the performance-based what-if of an option. And the whole thing is tied to how something else performs, usually a big stock market index like the S&P 500. And that's really the core concept. When you invest in an autocallable, you're basically playing a game with specific checkpoints. The whole point of the game is for your investment to hit a certain financial milestone by a certain date.
So how do you play? It's pretty straightforward, really. First, you put your money in. Then, on specific dates, what they call observation dates, the bank checks to see how the asset is doing. If it hits that preset milestone, boom, game over. You win early. The note gets auto-called, and you get your money back plus your payout. If it misses, no big deal. The game just keeps going to the next checkpoint.
Okay, let's put some numbers to this to make it super clear. Imagine you invest $10,000. There are basically three ways this can go. First, the early win. The S&P 500 does great, the note gets called early, and you get your 10 grand back plus a nice 6% coupon. Sweet! Second, maybe the market just kind of treads water. It never triggers that early win, but it doesn't crash either. At the end of the term, you just get your original 10 grand back. But, and this is the part you have to pay attention to, if the market completely tanks and falls below that safety barrier, you could actually start losing your initial investment. And that market loss scenario, well, that leads us right into our next big topic. Because with any investment that dangles a higher return in front of you, there is always a trade-off. You got to weigh the good with the bad. So yeah, it's that classic push and pull, right? The appeal versus the catch. On the one hand, the appeal is obvious. You could get much higher returns than a simple bond, and you might even get your money back early. But on the other hand, you've got the catches. Real market risk. These things can be super complicated, and a few other sneaky risks we'll get into. Now, let's be real, this is what gets everyone's attention, especially in a world where savings accounts pay next to nothing. A potential 5 to 8% annual coupon? That sounds amazing. But why is it so high? Well, simply put, you're being paid a premium to take on risk. The bank is basically paying you to be their insurance policy in case the market takes a nosedive. But you have to ask yourself, right? What's the real price you're paying for that juicy potential return? It's not free money. You're making a very specific bet and taking on very specific risks. So let's break down the big four risks you absolutely have to know about. First, market risk. We've talked about it. If the market tanks, you can lose money, period. Second, complexity. The fine print on these is no joke. Third, liquidity risk. Need your cash back early? Good luck. It's not easy to sell these. And finally, issuer risk. If the bank that issued the note goes bust, you could lose everything, even if the market did great. Okay, enough with the theory. Let's make this real. Let's walk through the story of a hypothetical investor, and we'll call her Sarah. Now, Sarah's story probably sounds familiar to a lot of you. It's 2020, interest rates are on the floor, and her savings are just sitting there, doing nothing. She wanted a better return, but she was also nervous about just dumping her money into the stock market and riding its crazy waves. The autocallables seemed like an interesting middle ground. So, she takes the plunge, puts $50,000 into a 5-year note. The first year goes by, and the market is flat. She's probably getting a little nervous, thinking, uh-oh, did I make a mistake? But then, in 2022, the market rallies, it blows past that milestone, and her note gets called early. And boom, here's the payoff. She gets her 50 grand back, plus an extra $7,000. That works out to a 7% annual return, and she got it all in just 2 years. For Sarah, this worked out perfectly. But what Sarah says here is so important. She's clear, this was not a sure thing. It was a calculated risk, and she knew that if the market had crashed instead of rallied, we'd be telling a very different story right now. And that really brings us to the million-dollar question. Is something like this right for you? Because these products are definitely not for everyone. So let's run through the questions you need to ask yourself. Okay, question number one, and this is the big one. How would you actually feel if that worst-case market loss scenario happened and you lost a big chunk of your money? If the thought of that makes your stomach turn, this probably isn't the game for you. Next up, and you've got to be brutally honest here, do you really get it? Do you understand all the terms, the call barriers, the observation dates, the downside protection? If you feel like any of that is fuzzy, that's a huge red flag. And what's your gut telling you about the market? Generally, these products do best when the market is stable or climbing slowly. If you're convinced we're heading for a huge crash, then, well, tying your money to a stock index is probably not your best move. And last but definitely not least, where would this even fit in your overall financial picture? An autocallable should never, ever be your entire portfolio. It should only ever be a small piece of a much larger, well-diversified strategy. You see, at the end of the day, an autocallable is just a tool. It's not a magic bullet. And like any powerful tool, it can be really effective if you know what you're doing, but it can also be pretty dangerous if you don't. So, where do we land? Is this a powerful tool for a savvy, informed investor? Or is it a complex puzzle that's just not worth the headache? Well, like with almost everything in finance, the real answer depends entirely on you. Thanks for tuning in.